Hello everyone. In this video I'm going to introduce chapter 8. This video includes two steps. In the first step I'm going to introduce the chapter at a macro level, and then we'll deal with the rest of the items or topics one by one at the micro level in another part of the video. Chapter 8 in managerial accounting. So chapter 8 is about master budgeting. So budgeting is basically planning, forecasting and planning and controlling the budgets for any manufacturing company. Master budgeting is basically the several or various budgets under one big budget. So to elaborate, we start, for example, with sales budget. And in the sales budget, you forecast how much you are expecting to sell, how much you expect to sell, and how much you'd expect to collect in cash. So this is the first budget that we have. Based on the sales budget, you move forward to the how much you need to produce. So the production budget. The production budget is basically based upon the sales. So if you want to sell 100,000 or you are expecting to sell or estimating to sell 100,000 units. And remember that when we say budgeting, we are planning ahead of time. So we are estimating or expecting. If you are estimating to sell $100,000 in April, 100,000 units in April, you would like to produce at least 100,000, and most of the companies have an additional margin, like 20% additional number of units produced, so that to account for extra sales. So they would produce 120,000 units if they are expecting to sell 100,000 units. Now, the production budget includes the three components of the cost, which you know really well after all. So the direct material, direct labor, and the manufacturing overhead budgets. So direct material budget, where you simply state or plan how much indirect material you would like to purchase and how you will finance this purchase. Direct labor budget, the number of working hours multiplied by the wages for this production. Manufacturing overhead is based upon the POHR or the activity base, which is usually machine hours or labor hours. Now, if you move from these three all together, they will get you to the one of the most important budgets, which is the cash budget. And the cash budget is also connected. So these three are costs and expenses. All of these are payments. Some of them might be on account as payables or in cash. So this is the component of expenses or costs. The revenues component has to do with sales. So sales is also related to the cash budget. Another component that has to do with cash, or what that affects cash, is the selling and admin expenses. So we have S&A, selling and admin budget. So how much expenses in selling and admin expenses you will incur, and how much cash will be paid. When you get all of this information, you can now tell, based upon sales and based upon the expenses and costs, you can prepare your budgeted income statement. So budgeted income statement. And therefore, after you get the retained earnings from the net income in the income statement, you can easily prepare a balance sheet or a budgeted balance sheet. Okay. This is basically everything you need to know so far. So we have sales budget, production budget that has 3 sub-budgets beneath it. All of these will help you get the cash budget along with the selling and admin expenses budget. The cash budget along with everything that we dealt with help us to get the budget income statement and eventually the budgeted balance sheet. These things go in order, okay? The sales budget is the first one. Then you prepare the production budget, direct materials budget, direct labors budget, manufacturing overhead budget. This is number 5. This one can be easily prepared on its own after, of course, preparing the production budget, because some of the selling and admin expenses are based upon production. Here we have a small budget that is called ending inventory budget, and this is basically related to what I mentioned regarding that you produce more than what you sell usually to account for any extra sales. Because if you have an extra demand in April, you cannot produce them in April right away. You should have produced them ahead of time to account for such an increase in demand. So we have an ending inventory budget. This takes place sometimes at the same time with the production budget. Of course, ending inventory also appears in the balance sheet budget, and I'll explain how this happens when we dive through the budgets, each one on its own. After preparing all of these, you get to prepare the cash budget. In the cash budget, usually you include revenues that are collected in cash, expenses that are collected in cash. If you have any loans that you are paying or interest on these loans, and if you have any dividend payments. So all of these are cash components that are included in the cash budget. This is an important budget, and it's a long one or a big one compared to the rest. Finally, after you have all the required information from revenues, expenses, and other costs, you can prepare the income statement, and the net income in the income statement goes in 2 ways, either retained earnings or dividends. And this retained earnings is added to the existing retained earnings under the balance sheet so that you can prepare the budgeted balance sheet. This ending inventory budget also appears in the balance sheet. But don't worry about this that much. This is a very simple step that we will see later on. So as we discussed, chapter 8 is about master budget. When we say master budgeting, we are referring to a budget that includes several budgets beneath it. Master budget, where we start with sales, we move on to production budget. The production budget is based on sales. So if you expect to sell 100 units, you would manufacture at least 100 units, depending on the ending inventory, the beginning inventory that you have. And you would like to have some additional units so that if your actual sales exceed the budgeted ones, so you'd, let's say, manufacture 120 units, and therefore the direct material, direct labor, and manufacturing overhead costs are based upon the production. So these 3 are based upon the production budget. Parts of the direct labor, direct material, and manufacturing overhead are paid in cash. So these are the costs and expenses along with the selling and admin costs. And part of the sales budget is reflected in cash, and the rest are receivables. When you have all of these figures along with the ending inventory figure, which is related to the production budget, you can prepare a budgeted income statement where you get the net income that goes in 2 ways, either dividends or retained earnings. This retained earnings is added to the existing retained earnings in the balance sheet, the old one, and therefore you can prepare your budgeted balance sheet. These are the answers, the questions that you need to answer in the budgets that you've seen in the previous slide. So a master budget is based on various estimates. For example, you estimate sales, you estimate collection of cash, and so on. The sales budget, which is the first one, requires 3 estimates or assumptions. What are the budgeted unit sales, the selling price, and the percentage of account receivables that will be collected in the current and subsequent periods. So, for example, if you sell $1,000 in this month, which is April, the estimates, the history of the company says that you will collect 40% of this sale in the same month, another 40% in the following month, so in May, and maybe 20% in the month after, which is June. So you know that the cash collection from this $1,000 sales will be 400 in April, 400 in March, and 200 in June, $200. Okay, this is just an example how this works. So the main learning objective is to prepare a sales budget, including a schedule of expected cash collection. And this is the example that I just gave. The given says, Royal Company is preparing budgets for the quarter ending June 30. When we say quarter ending June 30, we are referring to the second quarter, Q2. And this Q2 includes 3, 4, and 5. Sorry, 4, 5, and 6. I'm referring to April, which is 4, May, which is 5, month number 5, and June, which is month number 6. So we are preparing now a budget for quarter 2. Budgeted sales for the next 5 months are given: April, May, June, July, and August. So those are estimates or forecasts. You don't know for sure how much you will sell in April, but historically, and given the current circumstances, you'd expect to sell 20,000 units in April, and so on and so forth for the rest of the months. The selling price is constant throughout the months at $10 per unit. So now you can easily get the total budgeted sales for April, May, June, and for the whole quarter. And of course, the whole quarter is the sum of the 3 months. So this $1 million is the sum of $300,000, $500,000, and $200,000 for June, May, and April respectively. And these numbers, the totals, are simply the number of estimated units to be sold multiplied by $10, which is the selling price per unit. Now, the given also says, the history of the company says that you are expected to collect 70% of the total sale in the same month of the sale, and 30%, which is the remaining, in the following month. So assume that you made a sale of $1,000 in April. You will collect, so the cash in April will be equal to 70%, so $700, and the 30% will be collected in the next month, which is May. So in May, you will collect the $300 from April's sales. Of course, if you sell, let's say, $500 in May, you will collect out of this $500 70%, so 300 plus 0.7 multiplied by 500, which is 350. Okay, and the rest, the 30% of this sale, will be collected in the following month. So we're talking about $150. The given also says that in April, which is the first month of the quarter, the second quarter, the March 31st accounts receivable balance is $30,000, and it will be collected in April. So the first thing you'll collect in April is the receivables from the previous month. And this $30,000 is 30% of March sales, because those that were sold in March will be collected in April. So you can hear just a hint of logic. You can easily say that sales of March is equal to, if the 30% is $30,000, what is the 100%? Crisscross, you can get that it's $100,000, the sales of March. Okay, this is just to motivate the logic of the schedule. So this is the expected cash collection schedule. You will have April, May, and June, and the whole quarter. The first thing you collect in April is the account receivables balance for March. This 3/31 is the March 31st. You know, in the American style of writing the date, they start with the month and then they state the day. So 3/31 is the end of March, $30,000. Then you will add 70% of April sales to the April collection, and the 30% will go to May. So this is April sales. Then for May sales, 70% of May sales will be collected in May and 30% in June. For June sales, 70% will be collected in June and 30% will be collected in July, which is the beginning of the third quarter. So we will not see the 30% from June sales. Essentially, this is the account receivable balance for June sales. Of course, the sum of these numbers, these four numbers, so those two will give us some number. Those two, they have also a sum, and this 70% has its own sum. So we are adding up four numbers. The total of them is the collection, cash collection for the second quarter. So this is what I was saying. April sales, 70% of the $200,000, which is the total of April sales, is $140,000 and will be collected in the same month. The rest will go to be collected in May. The same applies for May, 70% in the same month and 30% in the following month. And finally, June sales, you will only collect 70% of June sales in the second quarter. The remaining 30% will appear in July, which is the third quarter. The total of cash collections is $940,000. Okay. Now, based upon the sales budget, you know, or you can tell how much you need to produce. So, the management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. So, assuming that in April, you will need to produce $100,000. You need to add to this 20% of the budgeted sales of May budget. Okay, let's take an example. The given says that on March 31, which is the end of Q1, quarter one, 4,000 units were on hand. So this is the beginning inventory. This is your beginning inventory balance in the warehouse. You need to take this into account when you are deciding on how much you will produce in April. So budgeted sales, 20,000 units. This is in terms of units, 50,000 units for May, and for June it's 30,000 units. You need to add to this the desired ending inventory, which is 20% of next month's estimated sales, and deduct from that the beginning inventory, because this is it already exists, so there is no need to produce it. So for example, in April, you should produce 20,000 units, which are expected to be sold in April. You need to add to that 20% from May's or the month of May estimated sales, which is 20% of the $50,000. We're talking about 10,000 units. So 20,000 plus 10,000 units minus whatever you had in the beginning inventory, which was given at 4,000 units. And eventually you will end up producing in April 26,000 units. Exactly, this is what I said. So this is simply demonstrating what I just explained. In May, you will sell 50,000 units. You need to add to it, or expected to sell 50,000 units. You need to add to it the desired ending inventory, which is 20% of June's estimated sales. So this 6,000 is basically 0.2 multiplied by the 30,000, 0.2 multiplied by 30,000. Minus whatever you had in your ending inventory in April, which is the beginning inventory in May. So the beginning inventory in May is the ending inventory in April. Think about it this way. On the 30th of April at midnight, you had 10,000 units. The next day, which is the beginning of May, this is the beginning inventory, which was the ending in May. So one day after that, your beginning inventory is 10,000 units, which is the beginning inventory in the previous month. As for June, you'll do the same. 30,000 units estimated in June, estimated to be sold in June. So you need to produce 30,000 units. You need to add to them the desired ending inventory, which is 20% of the next month. We know that the estimated sales for July, the next month, is 20,000 units, and this was given in the very first slide. Multiplied by 20%, so we're talking about 5,000 units. So add to the production 20% of the next month's sales, which is 5,000 units, and deduct from it the beginning inventory, which is the ending of the previous month, which is the 6,000. So you need to produce in June 29,000 units. Mind something here, that the ending inventory of the quarter is the ending inventory of the last month, which is June, and the beginning inventory of the quarter is the beginning inventory of the first month. So now you need to think of the quarter as one period, only one period, that has a beginning and has an ending. A very common mistake here is that the student would place the beginning inventory for the quarter as the beginning inventory for the last month. And this is a common mistake that will cause you losing the grade. So again, I repeat it. The beginning inventory of the quarter is the beginning inventory of the first month of the quarter, and the ending inventory of the quarter is the ending inventory of the last month of the quarter. So treat the quarter as one period, not three chunks. It's only one period. Now, after deciding on how much to produce, which is the production budget, we'll move forward to the direct materials budget, where you should have an expectation of the cash disbursement or simply payment for the purchases of material. So you know that when you are dealing business to business, you will purchase some raw material and you will pay part of it today and another part later on, or maybe all of it later on. So you need to have an idea of how much you will pay this month and how much you will pay the next month. The given says, at Royal Company, 5 pounds of material are required per unit of product. So for each unit, 1 unit, you will need 5 LBP or pounds. It's the same. This is a scale unit. 5 pounds of material or raw material. The management wants materials on hand at end of each month equal to 10% of the following month's production. So you need to keep an excess of raw material that is equal to 10% above your needs 10% of the following month's production. This is just to account for unsafe circumstances if you had to produce more than you estimate. On March 31, 13,000 pounds of material are on hand. So this is the ending inventory of raw material for March, and accordingly, it's the beginning inventory for April. The raw material costs, the cost of the raw material is 40 cents per pound, or $0.4 per 1 pound. So each unit, which costs me 5 pounds, will cost me $2, right? 5 multiplied by 0.4 is $2. Now let's prepare the direct materials budget. So the starting point, the first line, you will purchase raw material based on the number of units that you want to produce. So the first line, logically, will be the number of units of production. The material per unit of production is given at 5 pounds, or LBP. LBP stands for libras. Sorry, not LBP, it's only LP. My bad. It's only LB, or LBS, libras. Okay, so 5 pounds per 1 unit. Eventually, the production needs for this one is 5 multiplied by 26, so we're talking about 120, 130. 130,000 libras, right? So you need to purchase 130,000 libras of raw material, or pounds of raw material, to satisfy the production needs of April. You need to add to that 10% of the next month's estimated production. So 10% multiplied by the 46,000 multiplied by the 5 libras per 1 unit. Deduct the beginning inventory, which was given at 13,000 libras, and therefore you will get the number which you need to purchase in April, the number of pounds in raw material. So the first thing they've done, or they did, is to compute the production needs for each month, which is simply 5 pounds multiplied by the number of units. Then they will add the desired ending inventory, and the desired ending inventory is 10% from the next month's production. So 10% of the 230,000 is 23,000. Deduct from that number the beginning inventory. So you know that the beginning inventory of raw material in April is the ending of March, and therefore you get the number of pounds or libras that you need to purchase. You do the same for May. So 230 is the production needs. You add to it 10% of the next month's production needs, and you deduct the beginning inventory. Again, the beginning inventory for May is the ending inventory for April, and you will get the number of libras that you need to purchase. The same applies for June. The only hint here I need to stress on is that, not hint, only concept that you need to keep in mind all the time, that whenever you're dealing with the quarter, the ending inventory for the quarter is the ending inventory for the last month, and the beginning inventory of the quarter is the beginning inventory of the first month. So you are dealing with the quarter as one period, has a beginning and an end. Okay. Now, expected cash disbursement or cash payment. The given says that Royal pays $0.4 per 1 pound for its raw material, and this was already mentioned. one half of the month's purchases is paid for in the month of the purchase. So assume that in April you purchased 100,000 libras. Each libra is equal to costs me $0.4. So I'll be in total liable by $40,000. I'll pay half of this amount in April, which is 20,000, and another half in the following month, which is May. The March 31 accounts payable balance is $12,000. So in March, you purchased by X amount. Half of that amount is $12,000 that should be paid in April, the next month. So you can tell easily that X is equal to $24,000, which is double the 12,000. Now let's prepare or calculate expected cash disbursements. For April, the first thing you need to pay is the account payable balance from March. So this is end of March. And the balance of accounts payable should be offset in April before paying anything else. April purchases is $56,000, and this $56,000 is basically the number of pounds that was computed, number of pounds to be purchased in April multiplied by the cost per 1 pound, so $56,000. Half of it will be paid in April and another half will be paid in May. Now the same applies for May, 50% in May and 50% in June, right? And so on and so forth. So what are the total cash disbursement for the quarter? You need to calculate. So 50% of May's purchases will be paid in May and the rest in June. For June, you will only pay 50% in the same month. The other 50% will be paid in July, which is the beginning of the third quarter. So here you can simply add up the totals of the months and you will get the total that should be paid for this quarter or during this quarter. Now, as for the direct labor budget, I think this is a simple budget, of the simplest budgets. The given says that at Royal, each unit of product requires 0.05 hours, or in minutes is 3 minutes, of direct labor. The labor can be unskilled because the production process is relatively simple and formal training is not required. Royal is the company, pays its workers at the rate of $10 per hour. Okay, so you can easily compute the cost of direct labor consumed by producing 1 unit. So if 1 unit of product consumes 0.05 hours, and I know that the hourly wage is $10, therefore I'm paying, each unit is costing me $0.5 in direct labor. Okay. So again, the starting point in the direct labor budget is the units of production. So how many units I need to produce, and this can be figured out from the last line in the production budget. The time per unit is 0.5, and therefore labor hours required is 1,300 labor hours. Multiply them by the hourly wage, which is the $10, and you can get that the direct labor cost for April is $13,000. Okay. So this is very simple and straightforward. 10 multiplied by the number of labor hours required in production. Manufacturing overhead to compute it, you need to get the POHR, or predetermined overhead rate, first, depending on if it's a function of labor hours or machine hours. The given says, at Royal, manufacturing overhead is applied to units of product on the basis of direct labor hours. So we know that the activity base here is labor hours, or LH. the variable manufacturing overhead rate is $20 per direct labor hour. Okay. Fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, which is usually depreciation. When you see non-cash component, they are referring to depreciation. The given says in the schedule of manufacturing overhead, or the budget of manufacturing overhead, it's based on the number of hours worked. So it's a function of labor hours. So the first line must be the number of hours worked or estimated to be worked during a month. So the first line can be copied and pasted from the direct labor budget. So 1,300 labor hours are estimated to be worked during April. Then you multiply it by $20, which is the variable manufacturing overhead rate. You add to that the $50,000, which are the fixed manufacturing overhead cost, and eventually you deduct the non-cash component, which is depreciation. It's hiding over here, depreciation. You will get the cash disbursement or payment for manufacturing overhead. Now, here they are telling us that if you divide the total manufacturing overhead cost, which is the Y, by the total labor hours required, which is the X, you will get $49.70 per labor hour. This reminds us of what? The predetermined overhead rate, or the POHR. So the POHR here is $49.7 per labor hour. So as I said, when you are computing the cash disbursement for manufacturing overhead, you need to deduct the 20,000 units from the fixed manufacturing overhead cost, because these are depreciation, and depreciation is not paid in cash, but it is incurred as an expense in the income statement. So my total manufacturing overhead cost for April is $76,000, out of which $56,000 are to be paid in cash. Now, after computing a manufacturing overhead, you can compute the cost per unit. And the cost per unit comprises the three components of any cost: manufacturing overhead, direct material, and direct labor. Direct material first. We know that it's per each unit, it's 5 pounds or libras multiplied by $0.4, and this will give us a $2. Direct labor, we computed it at $0.5. We did that in the direct labor budget. And manufacturing overhead, in order to compute the manufacturing overhead per 1 unit, you need to compute the POHR, and you know that the POHR is equal to Y over X, which is the total cost, fixed and variable manufacturing overhead cost, divided by the total activity base, which is labor hours in this. So in this slide, they showed us how to compute the $0.5 cost of direct labor per each unit, which is, it requires 3 minutes or 0.05 hours multiplied by $10, which is the hourly wage, and therefore it costs me, each unit costs me 50 cents. The manufacturing overhead per unit should be computed first by determining the POHR, and POHR is the Y over X, or total manufacturing overhead for the quarter, which can be computed from the manufacturing overhead budget, or determined or observed from the manufacturing overhead budget, divided by the total labor hours required because the activity base is labor hours. So we know that for each labor hour worked, the manufacturing overhead cost increases by $49.70. Therefore, the manufacturing overhead cost per 1 unit of production is the number of required labor hours, which is 0.05 labor hours, multiplied by the hourly wage. Therefore, 2.49 is the manufacturing overhead cost per 1 unit of production. The total cost of goods sold per unit is 4.99. So this is the cost of goods sold per unit, or the cost of production. Now, from the production budget, we know that at the end of the quarter, we were left with 5,000 units multiplied by the cost per unit, which is 4.99. You can tell how much the finished goods inventory value is, which is the $24,950. And this will appear in the balance sheet, okay? In the balance sheet. So just to recap the whole thing, we started with sales, where we forecasted sales, then we went to the production budget. In the production budget, which is based on sales, we had three budgets beneath it: direct material, direct labor, and manufacturing overhead. From these three, you can compute the cost per unit, and therefore determine the value of ending inventory, which is our current slide or current budget. Now, a concurrent budget that takes place in parallel with the production process is the selling and admin expenses. This is an easy budget, just like the direct labor budget, I suppose. The given says that at Royal, the selling and admin expenses budget is divided into variable and fixed components. So we have fixed S&A and variable S&A, as always. The variable selling and admin expenses are $0.5 per unit sold. Fixed selling and admin expenses are $70,000 per month. The fixed selling and admin expenses include $10,000 in cost, which is depreciation, that are not cash outflows. So out of these 70,000, you'll be paying 60,000, and the rest of the 10,000 will appear in the income statement as depreciation expenses. Let's prepare the company's selling and administrative expenses. So we know that out of the budgeted sales, the 20,000, each unit will incur a $0.5 additional cost as selling and admin expenses, variable selling and admin expenses. This is a total of $10,000, which is the variable S&A expenses. Add to it the fixed component, which is 70. This will give us an $80,000 in total S&A expenses, out of which 70,000 will be paid in cash and 10,000 are depreciation. So it's not a cash component. You can do the same for May and June. The forecasted sales, which is the first budget, multiplied by the $0.5. Add to it the 70s and deduct the 10 to know how much you will pay. So this 230,000 is the cash to be paid. Okay, and this number here, the 260,000, is the number that you will see in the income statement, because in the income statement you have cash and non-cash components under expenses. The difference is depreciation mainly. So you need to make to distinguish between these two numbers and understand the difference, where the difference comes from. Cash budget. In the cash budget, we have 4 categories. The first category is about revenues, and which I'm talking about sales mainly, and whether it will be in cash or receivables, and how you will collect them. And this is basically from the cash collection budget. The other one is about expenses and payments, expenses and payments, or they call them disbursements. Then you have a financing budget and excess or deficiency of cash. So we have four categories or parts, not categories, parts in the cash budget. The given says the cash budget is divided into four sections: cash receipts, which is the revenues or sales; cash disbursements, which is the expenses or cost of material; cash excess or deficiency section. It determines if you need to borrow money. For example, if in April you ended up with $5,000, and as a policy, the company needs to keep at least $20,000 in its cash balance, you need to borrow on top of this value $15,000. Finally, the financing sections determines whether you need to borrow or repay some loans. So here, for example, you need to borrow. At some point in time, you'll have to repay this loan. Now, additional information before preparing the cash budget. Assume the following information for Royal Company. The company maintains a 16% open line of credit for $75,000. It means that the company can borrow from the bank without prior approval up to $75,000 at 16%. 16% is the annual interest rate. Okay, so per month it's 1.25. Actually 1.33, not 1.25. Doesn't matter. Anyway. Then the other point in the given maintains a minimum cash balance of $30,000. So a minimum of $30,000 should appear in the cash balance at the end of the month. If you end up with $20,000, for example, you will have to add to it $10,000 from the bank, from this line of credit. They borrow on the first day of the month and repays loans on the last day of the month. So here what they mean, if you borrow in April, you'll be borrowing on the first of 4. And this will be repaid at the end of the quarter in June, on the 30th of June. So you borrow at the first day of the month and you repay at the last day of the month throughout the quarter. They pay a cash dividend of $49,000 in April. So they have announced a dividend payment in April of $49,000 in total. Purchases $143,000 of equipment, $143,700 of equipment in May, and $48,300 in June. Both purchases paid in cash. So we don't have any payables. It's paid right away in cash. The last given says that the company has an April 1 cash balance of $40,000. So the beginning figure of cash is $40,000, and this is where we should start in the cash. So the cash budget starts with $40,000. Then you add cash collections, and this is the sales budget. Then you have a set of payments where you have direct labor, direct material, manufacturing overhead, selling and admin expenses, equipment purchases, and dividends. So this is from the direct material budget. This is from the direct labor budget. This is from the manufacturing overhead budget. This is from the selling and admin expenses budget, and this is given in the previous slide, and dividends are also given in the previous slide. Remember that from, for example, in manufacturing overhead and selling and admin expenses, we had some depreciation expenses, and those depreciation expenses should not appear in this budget. Okay. So the starting point is cash collections, $170,000 on top of the existing $40,000. The total available cash is $210,000. Then from the direct material budget, we know that we will be paying $40,000. From the direct labor, we will be paying $13,000. From the manufacturing overhead, we'll be paying $56,000. Here we remove the cash component. And from the selling and admin expenses, we'll be paying the $70,000. Also, we'll be removing the cash component. No equipment purchases in April. Actually, they purchased in May and in June. And finally, we pay the dividends that we have already declared. The total payments is $228,000. So this will give us a deficiency of 210 minus 228, a deficiency of $18,000. Okay, so remember that. So obviously here we need to borrow from the bank. Remember that we maintain a minimum cash balance of $30,000. So we don't only we not only borrow the $18,000, but also we borrow additional $30,000, which is a total of $48,000 from the line of credit. So borrowing $48,000, a positive cash flow because this is a cash inflow, and eventually you will end up with the minimum cash balance, which is $30,000. In May, where you end up in April, this is the beginning of May. Just like beginning inventory and ending inventory, ending figure in April is the beginning figure in May. Add to that the cash collection from the sales budget. So the cash available now is $440,000. Deduct all the disbursements or payments that should be paid. You will end up with an excess of $40,000. Remember that here we added one item, which is the equipment purchase, and we didn't have any dividends. And those four are from the budgets that we already prepared. So we have an excess of $40,000, and eventually, which is higher than the minimum. Remember that the minimum is $30,000. So there is no need to borrow anything from the bank, and this is where we ended up with what we ended up with, the $40,000. This figure will appear as the first number in June. So in June, we have the $40,000 that we started with. We add to it $360,000, which we got from the sales budget. The total available cash is $400,000. The first four numbers, direct material, direct labor, manufacturing overhead, and selling and admin expenses, can be determined or taken from the relevant or associated budgets, which we already prepared. This $300,000 is given in the previous slide, which is the additional equipment purchase. This is the one that we purchased in May, and this is the one that we purchased in June. We don't have any dividends, so we have an excess of cash of $130,500. Now we need to repay the loan that we took in April. Remember that we borrow at the beginning of the month, of the first month, and pay at the end of the last month in the quarter. The $48,000 which we borrowed has a 16% annual interest rate, 16% that for, per annum, per year, for 3 months. So simply divide by 4, 16 over 4, and this will get us 1920. Okay, 4 because we're talking about 4 quarters, or you can simply multiply the 16% by 3 over 12, which is 3 months out of the full year. As if you are dividing by 4, it's the same. 1 over 4 or 3 over 12, the same concept. And this is how we computed this I. So it's the 48,000 multiplied by 16% multiplied by 3 over 12, which is the portion of the year that we got the loan for. So this is the interest, and eventually we end up with this number, the availability of cash. As for the quarter, the beginning cash balance is the $40,000, which is this number. Here, by coincidence, we have the 40 in June and in April. What we take here is the April number. Total collections of cash is the sum of these three numbers. This one plus this one should equal this. And the same for the total available cash. Those numbers also, you need to have a row sum. So sum those numbers. This one plus this one is equal to this one. And the same for the rest. Finally, the ending cash balance over here should be equal to the last figure in the last month. So this is the beginning figure from the first month, and this is the ending figure from the last month, just like the inventory concept. And this is the cash budget. Basically, the cash budget is, probably the most important budget in the so far. Now we can prepare a budget income statement. In the income statement, the starting point is revenues, of course. The total revenues for the quarter is $1 million, and we got this from the sales budget. Minus the cost of goods sold, we sold 100,000 units, and the cost per one unit is $4.99. And this number, we got it from the ending inventory budget, which we prepared right after finishing with the three components of the cost, which are the direct material, direct labor, and manufacturing overhead. Accordingly, we end up with a gross margin of $501,000. Selling and admin expenses, including depreciation. Remember, including depreciation, it was $260,000, and excluding depreciation is what it was $230,000. This is the operating income. Then we have interest and taxes. We don't have any taxes here. We only have interest. So our income for the quarter is $223,080. Now this number will go in two ways: retained earnings and dividends. Okay. Now we can end up with the last budget, which is the balance sheet or budgeted balance sheet. The given says that you have a land of 50,000, common stock 150,000, so this is owner's equity. Retained earnings April 1, so this is the beginning retained earnings, 248,650, and equipment 175. I need to remind you that the ending retained earnings, which appears in the new balance sheet, and the date of the balance sheet, the new one will be June 30, okay, or July 1, it doesn't matter. So on June 30, the retained earnings figure will be the old one, so old retained earnings, plus whatever you added as net income minus whatever you paid in dividends. This is from financial accounting. I'm just refreshing your memory. So now cash, this figure over here, you can get it from the cash budget, and this was the ending balance of the cash budget. This 90,000 account receivable, we get it from the cash collection budget. Remember that we had 70% in the same month and 30% of sales are collected in the next month. So this 90,000 is the receivables. Raw material inventory, this is from the raw materials budget. So the ending inventory, which was, the figure was 11,500 multiplied by the cost per 1 pound or libra. Finished goods inventory, we also computed this in the ending inventory budget, which was $4.99 multiplied by the 25,000 units. Sorry, no, not multiplied by 5,000 units, not 25,000 units. And this number, we got it from the production budget. I'm just reminding you. Land is given, equipment, this number over here is the sum of the existing equipment which was given in the previous slide. So existing equipment plus the purchases of equipment in May and the purchases of equipment in June. And this was included in the cash budget. So the sum of these is the total assets. Accounts payable, this number over here is 50% of June purchases, because they told us that whatever you purchase in raw material, you will pay 50% in this month and 50% in the next month. So this 28,400 is 50% of June's purchases, because those will be paid in July. Common stock is given at $150,000. Retained earnings, the figure over here, I told you how to compute it. So the sum of total liabilities and stock owners' equity is $617,130, which is equal to total assets. So you can tell that the budgeted income statement is correct. So again, this figure over here, the retained earnings, the ending balance of retained earnings is equal to the beginning plus net income minus dividends paid. This dividends paid is given in the cash budget. Okay? And the net income is from the budgeted net income. This is the end of the chapter. Thank you for listening, and I'll see you with a new chapter.